Coming up today, stocks fall on rising Middle East tension. Shipping issues start to build. Israel's airport shuts down. Oil jumps more than 4%. Retail sales fall more than expected. J-Power on deck. And are we on the cusp of something major that we've never seen before? Stay tuned into this one, guys. Let's go. Well, once again, things are spicing up in the Middle East, making markets a little nervous here. Bit of a bearish breadth of a day there, with pretty much all sectors down across the board except energy, oil, and gas. On the back of a bump up in crude oil, as we could be on the cusp of a major military event, the likes we haven't seen for decades, with the US potentially about to take military action directly against Iran. And stick with me today because I'm going to show you later on an ETF that is moving higher this week that could actually benefit from all of this geopolitical instability. And it also comes with an annual dividend yield of 13%. But first, just giving you a bird's eye view of the market and where we currently stand. We just lost the greed zone for the first time in almost 2 months. Now getting back to neutral 54 as things do look to be on shaky ground. But we haven't quite seen an uncoiling in the stock market yet, still trading on low realized volatility. Even though we've seen a sharp rise in the price of the biggest input into the economy, crude oil. Currently just below $74 a barrel, as we do now have a wide range of possible outcome of what's going to happen over there in Iran. And that's why oil volatility has shot up. The price of oil-related options has to discount this wide range of possible outcomes. And just going out to a weekly chart, we've now got the oil VIX at the highest levels since the Russian invasion of Ukraine back in early 2022. And what is definitely a sharp divergence with equity market volatility. And if Iran does block the Strait of Hormuz, then all bets are off, as crude oil would likely spike to above $100 a barrel. Then I don't see how stocks wouldn't sell off hard in that scenario. And if it hasn't done already, that would likely prompt direct military action by the United States against Iran, as the US military has advanced weapons that Israel does not, like bunker buster bomb that could take out all of their nuclear enrichment facilities, plus take out the supreme leader and cut the snake's head off once and for all, as things appear to be reaching a boiling point, as we can see from the latest post from the US president, mentioning they have complete and total control of the skies over Iran. This is a big opportunity for the allies to take down the #1 aggressor in the Middle East and the man behind the current Iranian regime that has long terrorized the region, creating instability and constantly funding their proxy militant groups, cause havoc and target our ships passing by. So it's about time they're properly dealt with, in my opinion, and we could be witnessing the end of the current Iranian regime. The operation could be a quick, clean strike, take out their nuclear program, plus any remaining members of the regime's inner circle, and that actually might end up proving bullish for markets. But we still have other issues going on, and that very well could spark a fear spike, even if it only lasts for a day or two. We see VIX 25, 28 in the heat of the event, as right now it already looks like the war has been won before the battle. At this stage, it doesn't appear Russia or China is going to try and backstop. It actually benefits Russia a bit more, with the price of oil going up a little bit at China's expense, as they're the biggest buyer of Iranian oil. But Trump demanding unconditional surrender of Iran's leader kind of reminds me of George Bush Jr. doing the same thing back in 2003 towards Saddam Hussein, right before the US went into Iraq. So just like Iraq, Afghanistan, Syria, Libya, it could prove to be a very quick and clean campaign, but it did throw those countries into decades of civil war. The same thing could happen to Iran. But for us traders and investors, we have to be careful here. Even if it is a quick and successful campaign, it could have lasting effects, even just for a few months, with the price of oil and the movement of goods around the world, potentially also affecting inflation. Shipping groups already starting to shy away from the important Strait of Hormuz, as the risks there have been dialed up. It's already a very tight navigation lane. Any disruptions could have a material impact on the flow of goods, given the fact that almost 20 million barrels of oil move through there each day, or around 30% of the world's oil transported by sea. Also handles 20% of the world's LNG, and the corridor is only 33 kilometers wide at its narrowest point. And it's right on the doorstep of Iran, and they could be in their last days, making irrational decisions. A lot of these dictators, like Khamenei, are often delusional. They lived inside their bubbles, surrounded by yes men their whole lives, and so they could be on the cusp of doing something really stupid, which will seal their fate. And so for sure there's tail risk of something happening in the Strait of Hormuz, which some oil analysts think we could see a spike even to 125 a barrel. We're already seeing surges in product tanker rates, the price to ship oil, and it's actually the first time in Israel's 76-year history that its main international airport has been closed without any timeline for reopening. So this is a pretty big deal. We could be on the cusp of the final showdown here with Iran, which, like I said, has been aggravating the region and the West for decades now. And with that, we very well could see the ousting or the killing of their current dictator, causing a power vacuum and instability in Iran, at least, because as we've seen, they appear to be making some desperate statements. Apparently, just an hour ago, Iranian state TV says tonight a great surprise will occur, one that the world will remember for centuries. Do they already have a nuclear weapon? Or is this just a barking dog that's about to be put down? But they still have hope, even if it's small, potentially get a last minute deal done and sign a nuclear deal with the states. But they'll actually have to make good on their promise this time because, like we're seeing, if negotiations don't work, action will be taken against them. And so if China really wanted to step up on the international stage, show some teeth, and back a partner of theirs, now would be the time, but it doesn't appear so. They're just condemning the moves by Israel and calling for peace. And we can see in this chart here how much of Iran's oil goes to China. Only 5 years ago, it was less than half. Ever since 2020, it's pretty much all of it. And so this is the key asset in all of this. Like I said, what really drives inflation, big impact on consumer spending, the level of travel in the economy, how much discretionary spending there is, along with businesses as well. And if Iran thought they were going down, they may want to just try and upset things here in the West, even if it only is short-lived. And this comes at a time when global investors are already underweight. Allocations towards energy stocks, just looking at the percentage of fund managers, overweight energy down near record lows, in addition to a long underperformance of energy stocks versus the market. And as we can see in a bit of a sea of red today, it's actually energy shares catching a bid. XLE moving up there, and just looking at a spread chart of XLE versus the consumer discretionary ETF, we can see that starting to rise sharply over the last week as well. And those two sectors can often move in opposite direction, as the cost of energy, like I said, is related to discretionary spending. But for the here and now, it seems the market is quite complacent after this big recovery we've had. Wall Street coming back, lifting their forecasts, hedge funds and institutions increasing their allocations, and the likes of Bank of America putting US equities at the top of their list for their highest conviction views on 6 to 12 months. For tactical allocations, and just looking a bit further out at their 5-year strategic horizon, they're seeing infrastructure, equity, and private credit being the best place to be. Goldman Sachs as well, still holding on to their 6,100 year-end price target for the S&P 500. On the expectation, earnings should continue to rise into next year. But if that's not the case, where investors used to hide out for many years may not offer the same hedge like many of us are used to, and that's bond, which actually now have some of the highest correlations with stocks, something we haven't seen since last century, as most of the time since 2000, bonds and stocks have gone the opposite way, making bonds a great hedge and diversification for portfolios out there. And there's a look at TLT, which, if you weren't following the news, you wouldn't think much is happening in the world, as there's no signs of flight to safety. It's actually been gold that has been the safety trade so far this year. And now that we've done a V-shaped recovery, we've kind of come to the top end of the range of previous 20% plus drawdowns we've seen in the market. If we were to keep rallying here, this would be the best post 20% drawdown recovery we've ever seen, which would be remarkable given the global macro backdrop, huge spike in oil we've just seen. And there's a look at the weekly chart of the SPDR S&P 500 ETF, which is definitely pausing here a little bit, coiling up, as we're also approaching the start of a corporate blackout period where share buybacks will sharply drop off. Plus, we're approaching the end of Q2 next week. And given the huge rally we've seen in stocks, that could also add some selling pressure as massive funds do some rebalancing. And so I do think the market is vulnerable for a bit of an uncoiling here, even if it is just a 5-7% pullback, and hence why I positioned my options portfolio for such, while still holding some upside bets too. As I always seek to stay somewhat balanced and express multiple views at once. Because if the market can shrug all of this off easily, we could also be on the cusp of going into melt-up mode, as we're still just below all-time highs. But macro indicators are increasingly on shaky ground. In addition to cracks in the labor market, consumer spending as well. We just got retail sales data falling more than expected last month, giving us one of the lowest month-over-month contractions over the last couple of years that we normally see seasonally at the start of the year after Christmas spending drops off. And like I mentioned yesterday, another key indicator I follow is spending at restaurants. Consumers pulling back, dining out by the most in 2 years as well. And this is a key indicator of discretionary spending. When consumers are feeling good, they go out to eat more. So whilst not currently at alarming levels, there's still nonetheless a contraction in discretionary spending. And it'll be interesting to hear Jay Powell's commentary on all of this come tomorrow. We do have considerable upside and downside forces at play here, with the spike of oil stoking inflation fears and this little soft consumer spending data, along with the bump up in jobless claims we saw last week. Is Jay Powell going to keep holding the line, saying he's waiting for the impact of tariffs to be felt? Will he mention what's going on in the Middle East? What will he say about oil? And most importantly, how will markets interpret all of that once we hear from him tomorrow afternoon? Along with their dot plot and economic growth projections, we've actually seen the odds of a rate cut in September dialed back somewhat this week, probably as the market gets a little worried about the price of oil. But bond yields are pretty much just calling up here with the 2-year at 394 going into tomorrow. And we have seen a bit of a bump up in prices in the economy. Trueflation currently tracking a bit above 2%, and that is at multi-month highs. Also in play today, solar stocks getting absolutely hammered on the back of the Senate's bill phasing out tax credit. A proposed plan to get rid of those solar tax credits by 2028. But JP Morgan said the Senate version is better for shares of solar and other renewable companies than the version passed by the House of Representatives in late May. And there's a look at some solar stocks on my themes watch list. Sunrun down 40% today, Enphase Energy 23%, Plug Power off 16%, and First Solar down almost 18%. But there were signs of potential buying the dip, maybe big money seeing some value here, even though they've lost a bit of political support going forward. And with these huge moves, it creates dislocation in the normal relationships between solar stocks. Hence, I look to take advantage of that today with a pairs trade I put on with options and shared with members in real time, along with adding to my VIX hedges, as volatility does seem to be climbing here, but hasn't fully uncoiled yet. Along with the VIX one day getting back to monthly highs. Option dealers pricing in 21 tomorrow, which is a big jump for what they had been pricing in Fed day tomorrow. And we can see a bit of a flattening in the term structure, even though it's still in contango, but is getting quite close to backwardation that we've seen in over a month. And so if you're interested in trading options as well, I've got a private members chat room that's getting lively discussion every day, in addition to my private trading feed, where I share in real time what options trades I'm making in the last hour of the US trading session every day with my members, along with screenshots straight from my brokerage account showing you exactly what fills I get, along with justifications of why I'm making the trades that I am. And I report the profit and loss on every trade that I close. And we've just gone 1 month since I opened this server, the Market Makers Kit. And I just totaled the performance for all of my closed trades so far. And these stats can be verified by any MMK member, many of whom watch these videos every day. And so far I've closed 39 trades with 25 wins, 14 losses, given a win rate of 64%. Total profits have been a little over 6,300 and total losses a little over 4,000. And 1,400 of those losses were actually from one unlucky trade in Tesla. I got caught in that spat between Elon and the president. And whilst that can happen every now and then, large outsized moves, it was the largest single loss of market cap in one day for Tesla. And even though it just so happened in the first month of this service going live, it still didn't wipe out the whole month's profits. And I've still delivered over 2,200 in profits in the first month of trading, which is actually more than the cost of a yearly membership at full price. But the good news is, for a limited time only, you don't have to pay full price, as I'm currently offering a permanent 30% discount off both a monthly and yearly subscription to the Market Makers Kit. So if you want to get all my options trades in real time inside the private members chat room, along with getting access to all 28 of my custom trading view indicators, along with 9 training modules, then click the link below this video. Visit my site, clickcapital.io, and use code JUN30 to secure your spot today and see what trades I'm making tomorrow, as I'm active in the chat room in the last hour of every US trading session. And with all this volatility in oil, it's shaping up to create a lot of opportunities to trade around that in the energy sector and a few others as well that we're currently looking at. So you're welcome to jump on board and follow my trades starting today, as we are seeing some big moves in key market like gold, which I think would surprise a lot to find out that it's actually significantly outperformed the S&P 500 since the start of this century. Even though stocks have had a remarkable run, gold's actually done better. But wouldn't short gold be a contrarian trade here, given how bullish everyone's on it and how obvious the environment looks like for a gold bull run, which we've had a good one for a few years. In addition to energy stocks, fund managers have bailed on the US dollar this year to the lowest levels we've seen in 20 years. And pretty much like every market, when positioning, technicals, valuations, and sentiment reach extremes, it can often signal a bottom or top, just like we've seen in the past in the dollar index. When asset managers' allocation gets to lows, can often mean we're near the bottom. And again, this is a bit of a consensus trade, short the dollar, with big institutions around the world reallocating to Europe and Asia this year, and these events in the Middle East may actually kick off maybe a flight to safety to US dollars. And if and when we do see a successful campaign in Iran, after that's all dialed down, volatility's come off, maybe so will gold, quite a bit above the 200-day moving average here by about $500 an ounce. Then maybe it could be silver's turn to catch up, as it's lagged behind gold for a few years now. Also getting signs of uranium could be potentially a little bit stretched here, even in the short term, as it's been on a great run these last 2 months. And finally, onto that ETF I alluded to at the start of this video. Apart from energy, oil, and gas, shipping stocks were up a little bit today, and they've been firming a bit over the last week. Just looking at the Sonic Shares Global Shipping ETF here, under ticker BOAT, just crossing above its 200-day MA. And this is basically a pure play on global maritime shipping. Tracks the sole active global shipping index, and that gives exposure to 53 global shipping companies with almost half of the assets in the top 10. A good mix of large, mid, and small caps, and geographically diversified as well. 27% Asia Pacific, 25% Europe, with a bit over a third in the Americas. But the most appealing thing is an annual dividend yield of almost 13%, which, like we can see here in TradingView, is paid out quarterly. And just going out to a monthly chart, this has actually tracked sideways for a few years. But if we see further geopolitical disruptions, along with the price of crude and other commodities going up, that's a tailwind for shippers, as the cost of moved goods will rise and they stand to benefit. But they are very volatile and risky shares, hence why an ETF could be the best way to play it. And for now at least, it seems to be providing some uncorrelated returns with the market. You always want to pay attention to what ETFs are up on a down day in the market for clues of what's going on. Otherwise, that pretty much wraps it up today for the daily market review. We've got the Fed meeting tomorrow. Markets are shut on Thursday for US national holiday into Friday, triple witching, options expiry. All three of those things could be catalysts for the markets to get nervous. Not being able to trade on Thursday, along with a big unwinding in options positions this Friday as well. As always, the markets keep it interesting and challenging for us all, and we'll just have to wait and see with what happens in Iran, which could give us an uncoiling and volatility spike, even if only short-lived for a day or two. That is unless a last-minute deal can be made between the US and Iran. But if prediction markets are correct, at this stage, there's a 72% chance we do see direct US military action against Iran before next weekend. Pretty significant odds and hard to ignore for us traders. Thanks for tuning in. My name's Jared, and I'll see you back here again this time tomorrow. Cheers.